Welcome to the Deep Dive. Today we're digging into a financial analysis, the 361 Panorama from May 2025. We want to unpack a couple of key things for you from this report. First, how this, U.S.-China decoupling might affect India's manufacturing. And second, what's going on with valuations for India's small and mid-cap stocks. So let's jump right in.
Sounds good. Yeah, this report definitely gives us a lot to think about regarding global economic shifts and where India fits. That first point you mentioned, the U.S. looking away from China, the idea is that this could be, well, a significant plus for Indian manufacturing.
Okay, yeah, that makes sense on the surface. But the analysis mentions India hasn't fully capitalized yet. It's not like all that trade just shifted overnight. Why not?
Well, a big part is just the sheer volume. The U.S. dependence on China is huge. The supply chains are deep, really entrenched. You don't just swap them out easily. Plus, you've got China's massive production capacity, sometimes even overcapacity, frankly, so they can still compete very strongly on price.
Right. And the report flags a specific risk for India here, doesn't it?
Right.
It's not just about making more stuff, but making, higher value things.
Exactly. That's the core challenge. Avoiding the trap of just being the low-cost alternative. India needs to move up the value chain.
And there's a specific obstacle you mentioned. Something about rare earths.
Ah, yes, that's critical. China has a real stranglehold on rare earth elements. And those are vital for, well, so many advanced technologies, electronics, green tech, you name it. India's reliance on China for those materials definitely puts a cap on ambitions in certain high-tech sectors right now.
So if you're listening, you're probably wondering, what needs to change? What are the key factors that will decide if India can actually leverage this decoupling moment and, climb that ladder?
That's the million-dollar question, isn't it? It requires some very strategic thinking and investment. Okay, let's shift now. Let's talk about those small and mid-cap valuations in India.
Right, the second major point from the report. What did it find there?
Well, one key observation is about the market cap to GDP ratio. Basically, the total value of the stock market relative to the economy size. That ratio has grown faster than the profit to GDP ratio. So market value growth is outpacing profit growth, relatively speaking.
Okay, interesting. And that trend is even stronger for smaller companies.
Exactly. The report shows this market cap expansion has been much more pronounced for mid and small cap companies compared to the large caps.
So how do we know if that means valuations are getting stretched? What metrics does the report use?
One metric they look at is the relative price to book ratio, so comparing the PB of small and mid caps to large caps. And yeah, that comparison suggests valuations in the smaller segments are quite elevated. Perhaps stretched is the right word.
Okay, elevated PB. And there was something else, an earning yield spread. Can you break that down?
Sure. Think of earning yield as the inverse of the PE ratio, basically. The earnings you get per dollar invested in the stock. You compare that yield to what you could get from a very low-risk investment, like a government bond. That difference is the spread, or the risk premium.
So what's the spread telling us about small and mid caps?
Well, the report indicates it's actually negative, which is counterintuitive. It implies investors are essentially accepting lower potential returns for taking on more risk compared to safer assets or even large caps sometimes, a negative risk premium.
Wow, okay. Accepting lower returns for higher risk, that doesn't sound sustainable. What's the potential fallout the report warns about?
The risk is that if market sentiment shifts or if there's a downturn, these small and mid-cap stocks could be hit particularly hard. Those strong gains we've seen could reverse quite sharply because the valuations might not be supported by fundamentals alone.
All right. Which brings up another question for you listening. What could actually trigger such a market turn? And what does that negative risk premium really signal about the current investor appetite in these segments? Suggests maybe some frothiness.
It certainly suggests caution is warranted. There seems to be a high level of optimism baked into current prices for smaller companies.
Okay, so let's try to wrap this up. This 361 analysis gives us two main takeaways, it seems. One, there's a real window for Indian manufacturing thanks to U.S.-China shifts, but the strategy needs to be about moving up, not just filling low-end gaps.
Correct. And dealing with challenges like the rare earth dependency is key to that upward move.
And two, valuations in the Indian small and mid-cap space look high by several measures. The metrics suggest a potential vulnerability, especially if market conditions change.
Precisely. The negative risk premium is a particularly strong warning sign there.
So pulling all this together, here's a final thought for you to consider. Given this backdrop, the global opportunity and the domestic market risks, what are the most critical policy moves and maybe investment strategies India needs now?
Yeah, what are those make or break decisions to navigate this complexity and ensure, sustainable growth down the line? Something to really ponder.